Hey guys, it is Patrick with Financial Grit Media. If this is your first time watching our video, make sure you press the subscribe button and turn on the notifications. That way you're notified every time we post a new video to this channel. Now, this video is all about our 1 month review with the $150 investing challenge. It's been a full month since we invested $150 into 4 index funds. You're going to see the results in this video, and you're also going to see just the actual transaction for our second month. So we've invested another $150 in those same 4 index funds, and we're ready to rock and roll. So with that, we're going to go to my screen right now, and I'm back. And so now you should be able to see my screen, and we're going to walk you through kind of what has happened over the first month in this challenge. Now, before we talk about all of that, the one thing that you have to know is February was a rocky month. There was a lot going on politically. There was a lot going on in the stock market. And so there's a lot of factors that go into it. But again, we're in it for the long term. So as we go through these slides to help you understand what has happened, I don't want to deter you that, hey, just because we have a bad month doesn't mean that we shouldn't have been starting this challenge at all. And you're going to see that at the very end, towards the end of this slide deck, you're going to kind of see, hey, it's not all that bad because what goes down can go up. And so that's what we're going to take a look at. So let's dive in and kind of recap what we did for those of you that are new. So let's start off with this slide here. So this is kind of an understanding of what we invested in last month. So at the end of January, we invested $150 into 4 index funds. So if you split that up, that's $37.50 in each one of these 4 index funds. The way that I chose them is I picked one international index fund, I picked a small cap, a mid cap, and a large cap, and we just threw $37.50 into each one of those funds. A month later, so we're now a whole month later, you can kind of see the balances. You can see our cost basis was $150, but you can see our market value is only $146.31, so we lost some money over the first month that we did this challenge. You can see right in red the gain or loss. It was a loss of $3.69, and we've lost 2.46% of our investment. But hey, we're doing this for the long term, so we don't care about the initial ups and downs. What we care about is what happens in the long term of this challenge. The cool thing about this dashboard right here is you're going to see the gains and losses for each individual index fund that we picked. So you notice that for the international index fund, we lost 3.49%. For the small cap, we lost 2.29%. The large cap, 1.15%. And then the mid cap, 2.91%. And we're going to look through all of that here in the next couple of slides in the few minutes that we have. You'll also notice that it says the account value is $296.31. That's because I've already put in another $150 in cash at this point in time when this snapshot was taken to be ready to invest it once again for month number 2. All right, so let's start our discussion here against the S&P 500. Now, I know some people might say, hey, it's not fair that you are comparing everything to the S&P 500. That's very true. But we're going to look at this from a top level in comparison to the S&P 500, and then we'll look at some of the other indexes that we can compare our investments to. Now, what you'll notice here on this on the slide right here, you notice that the outlines, so the dip that you see towards the bottom here, the S&P 500 dip right here. So this is the S&P 500 dipping down low, and then it shoots up real high. And so it's kind of like the S&P 500 was kind of the boundaries. Now, we saw in the beginning of the month of February, literally like a week after we started this challenge, we saw losses after losses after losses because the market was just down. And then it started to pick back up a little bit. And notice that that's why you see a spike here in the first quarter of that month. You see kind of the spike here, and then it went down again, and then it went up, and then it kind of sustained itself from a percentage return standpoint. So it's at least returning a little bit of money. But you see how the swings are. I mean, on the worst day of the S&P 500, we're losing about 20% over the time we started the challenge till when we got out, or when the market, what we call bottomed, on whatever day that is towards the beginning of February. And then it shot back up, and then it shot back down, and it shot back up, and then it kind of steadied itself out for the rest of the month. But as you can see from our portfolio amounts, we're still in a loss position. So let's just look right now at the international fund. So the international fund returned us a negative 3.48%. Now, the index in which we're going to compare it to is the MSCI EAFE index. So that's the index that's kind of related to this. So what we're trying to do is we're trying to relate our index to kind of a standard baseline index. And so we're using MSCI EAFE index. It's kind of like an S&P 500. It just gives you a baseline, and then you compare your investments to that. So we're comparing this, and the reason why we're comparing this is the MSCI is closely related to what the fund is trying to do, which is invest in international stocks. Now, if you look at this chart right here, the MSCI is in the light blue. Our investment is in the dark blue. Notice how our dark blue doesn't have as much volatility as the MSCI. So some would say that our index is doing a little bit better than the benchmark that we're using of the MSCI, which it did, because the MSCI returned a negative 4.33% over the first month that we've owned this, versus ours returned negative 3.48%, about a 0.8% better than the MSCI. So again, sometimes we see this because of the riskness of the index funds, or the lack of risk that it really has when it comes to the benchmark that we're using. So that's what this looks like against the MSCI. Now let's take a look at our small cap. Our small cap, the benchmark that we're using is the Russell 2000 Total Return Index. In that one, we returned a negative 2.32 in our index fund. The Russell 2000 returned a negative 3.52%. So again, less riskier, you could say, of the Russell 2000. Notice it's kind of exactly right with the Russell 2000. There are some points where it didn't have as much gain as our index fund is, and that might have to do with just the percentage ownerships of different stocks that our index fund has versus how the Russell 2000 TR tracks its own investments. Again, if we move forward to the mid cap, the target benchmark is still the Russell 2000, a total return index. For whatever reason, if you notice, our index fund for the mid cap was a little bit more loss than the Russell 2000. So our loss was negative 3.75% versus the Russell 2000, which was negative 3.52%. And so it's just about 0.25% difference here, quarter of a basis point here. And so we're kind of right in line with the Russell 2000 when it comes to our mid caps here. So again, nothing shocking as far as our return versus our benchmark, except we kind of lost a little bit from the benchmark by 0.25%. The last one that we're looking at here is the large cap index fund. The large cap did the best when it comes to losing money. It didn't lose as much against the benchmark that we're using. The benchmark that we're using is the S&P 500 total return index, which would make sense because the S&P 500 would have your 500 largest companies in that index, and of course the large cap would be the largest companies in the United States. We returned a negative 1.19% versus the S&P 500 total return index returned a negative 3.64%. You know, when you're looking at this chart, you might go, how does that happen? Well, if you look on the light blue line here in the first quarter, you see that huge dip, and then it kind of goes up, but it doesn't really go up enough to scathe the decrease, that 6% decrease that happened in that day. And so that's probably why our return was a little bit better than the S&P 500 total return, is because it just couldn't recover enough from that dip towards the early early of the month of February. So now that we've looked at all of that, and I know it was a quick review, but there wasn't much to it. It's, we're trying to track, we're trying to do better than the benchmark. And for all of them except for one, we are doing better than the benchmark. Unfortunately, it's all negative, so some would say we're not doing better than the benchmark. But again, we're just taking our investment and benchmarking it to what's going on in our benchmark, particular to the investments that we've chosen. So looking at the asset allocation breakdown, this is an important one. This will start to be different as time goes on. So again, 1 month in, there isn't much difference here. But if you can see on January 29, 2018, which is when we started the actual fund or the challenge, we put 25% in large, 25% international, 25% in small, and 25% in medium. As of the end of business day on February 26th, which is about 1 month. Again, we don't have 29 days in February, so we're kind of pushing it a little bit. Notice that international now makes up just a hair smaller than 25%, as well as the mid cap. But then the large cap and the small cap is a little bit more. So it'll be interesting to see over a long period of time what happens to that based on the return of the market. What should happen is that small cap should become bigger than the large, and that medium should stay in the middle. So if theory tells us right, that small cap, let's say, I'm just throwing numbers here, should be like 30%, whereas the large might be 22%, and that mid cap stays in that 25%. International is a little tough because it also depends on where they're investing, but that international could be as big as the small cap because more risk, more reward, and that's where these numbers kind of fluctuate. So it'll be interesting to see what happens a year from now if small cap does become bigger because the more risk, more reward. With more reward, that means more of our money from a portfolio standpoint would be in small caps than it would be in large caps. So again, we'll see how that works as time goes on. So the big thing that we want to understand is the total investment return. And I wanted to show you this because it's important to understand where the low points of our investment challenge were and where our high points of our investment challenge were, and then where did we actually land at the end of 1 month period of time. So the way that we would calculate total investment return is we would take our total return and we would divide it by our initial investment. Well, in this case, that would give us our total investment return for the period of whichever period we're using. So if we looked at our account every single day and we looked at where the balances was, our lowest point was on 2/8/2018, where our entire balance was $137 instead of $150. So at that point, we lost $13. So our total return was a negative $13. We invested $150. So at that point in time, we lost 8.67% of our portfolio. And that would make people a little bit jittery because that's a lot of money. I mean, to lose 8-9% basically in about a week's time is not a great feeling. So then let's kind of fast forward a little bit and see where was our highest point. Where was our money at the highest portfolio amount? Now, obviously, we didn't clip over $150 because we had a down market. But on 1/30th, and I know that sounds bad, the next day that we invested, but the highest point in our month was 1/30th, and we were at 148.69, which basically told us that we lost money that first day, but we didn't lose as much as if we did holding it for another week. But on the highest point day, we were at 148.69 investment, so we only lost $131 out of a $150 investment. Gets us 0.873 return negative. So we lost a little bit of money there. Now, how does that all shake out? Okay, so let's disregard that for a second because that was like our first day. But our lowest point was a negative $13. We lost 9%. Let's just round it up 9%. At the end of the month, we climbed and climbed and climbed. We had some down days, but we climbed, and we ended the month with $146.31. Meaning that instead of losing $13, we only lost $3.69 over a 30-day period. If we did the total investment returns on that, we would have gotten 2.46%, or losing about 2.5%. So we went from a negative 8.5% all the way to a 2.5 negative percent. And so we gained, some would say you would gain 6% in that time period just by holding. Now, the key thing here is that there were investors that were very worried about the market. And because they were very worried of the market, I'm pretty sure they would have sold on 2.8. Now, we're in this challenge for the long term, so we're not going to sell it on 2.8. We're just going to keep it. And because we kept it, we were able to get back $10 over investment, or about 6% of our investment. So if there's something to learn in this first month, it's that when times get tough and the market's down, we still have to keep focus on what we're trying to do from an investment strategy. Our investment strategy is $150 for index funds every single month. We don't care about the short-term losses or gains. What we hope for is, in the long-term run, continued gains. Okay, that's what we're looking for at the end of the day. Okay, now just to kind of wrap it all up. So yesterday, if you're watching this video, it was yesterday or the day before, we executed 4 more trades, $37.50, $150 over 4 index. So here's what it looks like right now. And actually, I was a day late in screenshotting this, so there was a little bit of losses that happened. There's always a lag because of when I get things done. But notice here, the account value is $290, so we've lost $10 in a span of a month, basically. We've invested the $150. You'll see some of the price changes here. You'll see now at the far right column of this dashboard, we're now back at about 25% for each one. So the international is right now sitting at 24.82% of our fund. The small cap is at 25.09. The large cap is at 25.09. And the mid cap is at 25%. So you're kind of seeing that change a little bit with all of these investments and the investment allocation, even after we've made those investments. You'll also notice the cost base. Now we have $75 in each one of those funds. Our worst one right now, as of right now, is the international. We're losing about 4%. And then the mid cap is next with negative 3.33. And then we're at about 2.95 for small and large. So again, this gives you a picture of what it looks like right now after we've made our next investment. So what does that mean? Well, we're still steady in what we're trying to do. $150 a month for index funds. Next month, we're going to see what happens in the month of March 2018. Hopefully, the market will go up and we'll recoup a lot of our losses and finally get into the profits. But again, you got to remember that we've been in 8 years of growing economy and 8 years of record-breaking stocks. So maybe this is just the time that the stocks are down to make up for everything that happened. Now, one thing to know is that we were in a correction. So when that first month of February happened, we went into a correction, which means a correction is 10% downturn of the stock market in a certain time period. So we did have a correction. We didn't hit necessarily recession. Recession is 20%. So we haven't gotten there yet. Hopefully we won't get there, but that's where we are right now with our investments. So again, $150 challenge investments. This is what it looks like right now. We took a loss. We took an L for the month of February. We're hoping that we can take a W for March and even a WW, meaning that we made up all of our losses from February and March. But we'll see what that happens in our next $150 challenge video. So that's it. That's where we are with it. We now have $300 in the market with our challenge, our $150 challenge. We'll see what it looks like as we go through the month of March. I hope you enjoyed this video. If you did, make sure you press the like button. Make sure you also press the subscribe and turn on the notifications. That way you're alerted the next time we upload the next challenge video on this channel. And leave me a comment about what you think about this challenge and whether or not we can come out of this in the positive at some point and hopefully make that 10% or 9.5% clip each and every year for the next 40 years. So with that, we'll see you next time on Financial Grit.